Why is it that we're always so fearful when it comes to money that what if I lose it? I need to have another pocket somewhere.
When it comes to money, I mean, like, it's just like going to the gym. You just have to like sweat and cry and be in pain.
Understand your risk appetite.
Been in the trenches. I know how it is to lose money. I know how it feels to just look at your account and see just the negative just piled in.
As a smart investor, you're supposed to cover any areas that you might fall short. It is a muscle that you're exercising.
And the younger you are, the more you can take on more risk. I hate the fact that, you know, black folks are always in fucking last place. You know, we're just we always are.
When others are fearful, become greedy.
Okay.
And when others are greedy, become fearful.
Okay. Welcome to Just Money Podcast. This is a space where big ideas, smart money, and real opportunities converge. I'm Just Ivy Africa. Every week, we speak to the sharpest minds in business, investment, and innovation. If you're new here, subscribe to our YouTube channel, The Kenyan Wall Street, for new episodes weekly, and find us on TikTok, Twitter, Instagram, Spotify at Just Money Podcast. In today's episode on money and investment mistakes, we're joined by Stormzy Mwendwa, an investment educator and financial content creator known for his GARP strategy, and Gertrude Njeri, community manager at HISA, who's passionate about simplifying investing for everyday Kenyans. Before we continue with the conversation, this episode of the Just Money Podcast is proudly brought to you by HISA app. HISA is powering borderless investing for Africa, giving you access to both local stocks like the Nairobi Securities Exchange and global giants like Apple and Tesla. The episode is also proudly brought to you by HFM, a global multi-asset broker in forex, commodities, indices, shares, and crypto, you name it, founded in 2010. Get a tradable bonus of up to $500 on your first deposit. Plus, for the first 25 days, your losses are matched with bonus funds only on HFM. Finally, thank you to Kofisi, who have provided our beautiful, beautiful set. Kofisi creates world-class spaces for ideas like this to thrive. Welcome back to another episode of Just Money Podcast with me, Just Ivy Africa. I'm actually so excited because there's a new age and a new dawn of money educators on social media. Nowadays, I get a lot of my content from TikTok, and I'm a big fan of these two people. Actually, let's just start here with Gertrude. I always like to say ladies first. Gertrude, please say hi to the camera.
Hi, everyone. Thank you so much, Ivy, for having me. And as you had, my name is Gertrude, and I work at HISA. I serve in the research and training department. And I'm so happy to be here.
Yay! Thanks for joining me, Gertrude. And we have Stormzy.
What's up, everybody? Yeah, it's great to be here. Thanks so much, Ivy. I mean, we've been looking forward to like doing this. Even there's a dude from my team who tried to reach out to the team to see if we could like work together, and you know, just the universe works.
Yeah, was it? Did you guys try to reach out to me through TikTok? Because I literally discovered TikTok messages like 2 months ago. I was like, oh my God, I've lost so much money and opportunity by just never checking my TikTok messages. So I hope not. But now you have my number and we can talk.
Absolutely. Yeah,
okay. Yeah. And before we start, I always like to ask a particular question on this podcast. There's a lot of misinformation, disinformation, great information. It's information overload on social media, particularly when it comes to money, financial literacy, investment options, whatever. So whoever's listening to this podcast today, why should they pay attention to you, Stormzy? What makes you special? What makes you different?
Yeah, I've been in the trenches. I know how it is to lose money. I know how it feels to just look at your account and see just the negative just piled in. I was actually telling Gertrude this story when we were outside just for a quick second, and just telling her like the tuition fees, because that's kind of like what I call them, for learning is, you know, it can stack up a whole mile if we start doing that. But with that being said, why should someone even listen to me? I mean, I do this. This is what I do for myself, for my clients as well. And thus far, I mean, we've been able to return some significant returns on this bull run and this bull market. So really, really happy to just go ahead and just divulge as much as possible, because I feel like what you're doing here is really amazing, just educating and giving folks a platform to be able to learn and for free and all that kind of stuff. So that really, really resonates with my principles. So yeah, this is really
you told me you started investing when you were 17.
Yeah.
So how old are you now?
I am 33.
Oh, you're not a child.
Oh, yeah, I'm old.
You're a geezer.
Yeah, I'm an old man.
It's your Jesus year.
Yeah, it's my Jesus
Are
year.
you making ungodly money?
I can't say that.
Okay. This is a transparent podcast. We don't gatekeep here. So
Okay.
if I need to listen to you, I need to know that you're making good money. But I remember I saw you sharing a screenshot on TikTok of some money that you had invested in a particular stock, whatever. So
Yeah.
okay, good for you.
I appreciate that.
Good for you. And thank you for sharing your knowledge with us.
Yeah.
Gertrude, why should anybody stop the scroll and listen to what it is that you have to say today?
Well, the thing is, as Stormzy has said, we are investing and sharing the lessons that we learn. So instead of you following someone because they are old, how many old people do you know are investing in the stock market? Go to the people who are doing what they are preaching. Yeah, as simple as that.
How do we have proof that you are doing what you're preaching? It's very easy nowadays to preach. Just go to AI, get something, come on social media, say. How do we get proof that you guys are actually doing what it is that you're saying you're doing?
So on my personal pages, I usually share the lessons that I'm learning. But in addition to that, at HISA, what we have incorporated is we not only give you access to these markets, but we also give you the heads up. What's happening in this market? What should you expect in the other market?
Yeah.
So instead of just looking at a person based on, they could have gotten that information from AI, ChatGPT and this, but what are they doing at the end of the day?
Yeah.
Do they have backing to back up what they're saying?
Yeah.
If, for example, there's
exactly. You have the backing to back up what you're saying. Yeah.
Yeah. For example, there are these videos that I usually come across online, and you listen to this person saying this and that about the stock market. Yet, after you've done your own research, you come to find out what they were saying is so wrong. So in addition to you listening to these people, you have to learn on your own. So look at the people who are backing up what they're saying to learn for yourself. There's no need of you just listening and consuming videos, yet you're not taking the step to learn more.
Very true.
So learn and look at whether this person can back up what they're saying.
A disclaimer, please remember, everything we say on this podcast, there is no financial advice here. This is for educational purposes. If you hear Stormzy saying something, Gertrude saying something, and then you decide to rush out of your door and go and invest through their particular strategies or something you don't understand, and then shit hits the fan, don't come back here. Blame yourself. Which brings me to one of our first hot takes. But even before then, Stormzy, you said you've been in the trenches. You've lost money. Tell me about that.
Oh, yeah.
What happened?
Oh, my goodness. Yeah.
So,
to kind of like just backtrack to, when I was 17, of course, that's when like my mom bought my first stock.
Yeah.
I can't even remember what it was, but I think it was like a manufacturer or something. But that was the first introduction into now high finance, if you can call it that. So from there, when I was in university, I met a couple guys. They introduced me to this whole forex thing. You've talked about this as well. So you know what this is like. So this is in the age of early Instagram. And I was actually telling Gertrude as well. There's these guys, these UK guys, young guys, who used to like post, videos of them in Lamborghinis, very beautiful women, and you're like, I want that. But at the back end, they were like, okay, we'll teach you how to trade for £999. I'll never forget that price.
£1,000.
Yes.
When you were 17.
Yes. So back then, so these guys are selling $1,000 course, and now looking back at it, retrospectively, I'm like, that's how they were able to afford these things, because people are just throwing this money at them. So anyway, long story short, we decided we're gonna try this as well. So started off, in fact, one of your sponsors, HFM, that was the platform that we started off with when they were Hot Forex, before they changed their name to HFM. So used to use Hot Forex back then. So we started off with $100. That was my savings. I went ahead and proceeded to just lose that expeditiously, I think in like a week, because I didn't know what I was doing. So that was the first tuition fees paid. Went in bigger, $500 after probably like a month or so.
Where are you getting this money?
So some I was saving, and the others I was basically just borrowing my mom. Shout out to my mom for that, by the way.
Oh, thanks, Mom.
Yeah. So she used to loan me some of this money, so that in her own words, she was like, I'm doing this so that you can never say I never supported you. And because she was like, why are you even doing this? If it was this easy, everyone would be doing it and sitting down and making money, which is wisdom. So anyway, $500 proceeded to also lose that expeditiously as well in more or less than a month. I was actually telling Gertrude the same thing. Then I was like, okay, cool. I'll take a quick breather, try and learn. That's what I did. Put in more. I borrowed some more from my mom. I think she fronted me like 800 and I did like 200 and something. Went in with 1,000. This one was.
And when you say went in, this is trading.
Yeah.
This is forex trading.
This is forex trading. Exactly.
Without buying the £1,000 course first. You just said it, I'll do it on my own. Okay.
So did that. This was a slow bleed. Lost money over time. Nice and slow bleed. Eventually, I hemorrhaged everything and I was like, okay, this is clearly not for me. I really need to understand what's going on from top down, do a whole full 360 view, a holistic view of how am I losing money consistently? Is the game rigged against me? And eventually I came to find out the truth.
Which is?
The game is rigged against me.
Tell me more.
Yeah, so basically when you look at the hierarchy of high finance and basically just markets, they're the big banks, big money. Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan Chase. They have their own divisions that do trading and they carry a ton of money. Like if I'm not mistaken, when you join in as a junior associate in Goldman Sachs, they give you, is it $10 million to just play around, just learn. So this is your competition. So someone is playing around 10 million. And of course, they're graduates of business course probably from Yale or I don't know where. So really smart folks, folks who also have like really nice degrees in mathematics and physics and all that stuff. So really intelligent people working for the banks. So there's that. That's the top of the food chain. And then you come to your brokerage firms. They will also, of course, now what I learned is they approach the big banks and say, we'll give you retail traders, we'll give you retail customers if you open up a line of credit for us. But I think you have to front, if I'm not mistaken, but I feel like it's like a quarter billion dollars. Yeah, you just have 250 million. That's, like your working margin. And then the rest, they can just give you a line of credit. So cool. They will bring in the customers, the people like me. And onboard us and stuff like that. And so you have your brokerage firms, then you have now the players. So your retail traders, your massive traders as well. You have your HFTs, which is high frequency traders. You have your hedge funds. There's like a whole ecosystem of players just under the brokerage. And yeah, so basically retail traders, folks like me, are stupid money because we don't know what's going on. We'll just buy and sell based off of how we feel or some charts and stuff like that. So with that, like when you see your competition, you're like, it's like I'm going to play against Messi today. He's been doing it for years. I haven't done it for, I don't know, a really long time. And even if I was, I'm not as pro as he is. So with that competition, I'm like, okay, what are my odds of winning? They're not really that much. So it kind of explains why I was just hemorrhaging money over time. They were taking the bets against me and I was playing a zero-sum game with forex trading. So yeah, that was my lesson. And I was like, okay, cool. Need to take it easy from here and just do something else.
Okay.
Yeah.
So if you could summarize in the mistake that you made when you started this journey, what would that be in one sentence?
Yeah, lack of education and not knowing the game itself.
It is a game.
It is a game.
Okay.
Yeah.
Okay. Which brings me to my first hot take, and I want to get Gertrude to answer this because you've said, Stormzy has told us one of the biggest issues was he had no education. So we scoured the internet for a few hot takes around investment and, the biggest bubble in Africa is in stocks. It's financial advice itself. So are advisors helping or profiting off ignorance? What do you think?
That's a spicy one. The thing is, of course, there's some advisors, quote unquote, who are in it for selling those courses. But at the end of the day, you'll still find a few genuine people. For example, on HISA, what we do is we first start with educating the user. Then we give you options. Once you understand, when stocks move up, what am I supposed to do? When stocks go down, what am I supposed to do? How do I make money? Once you get that, then we give you the options. For example, each week we share email campaigns for any user, which are free of charge. These email campaigns are there to educate you. You get to understand what happens when this company announces that. On Wednesdays, we share stock spotlights. This is whereby we look deep into the companies, the data, the finances. What does this company do? How do you make money? How is the potential and the outlook? Then we also have our videos, which are free to access anywhere. You can find our trainings on the stock market and also the platform on YouTube and other social media platforms. So we start with giving you the education. From there, we give you the options on how you can make money by accessing the stock markets.
How long do I have to be educated for me to start making money, for example? Or is there just a particular basic strategy? And I'd like Stormzy also to comment, because I want you to tell us what the GARP strategy is really and why that makes sense for you and not something else. So, because at the end of I don't have time, I don't have time. And I'm lazy and I want to start making money now. So what are the basic principles that I need to apply so at least I can start in January and by end of January, I'm making some money?
Okay. First things first, understand the basics. When you invest in stocks, what does that mean?
Yeah.
How do you... Okay.
Yeah.
So when you invest in stocks, a stock represents part ownership of a company. So when Ivy buys Safaricom or Tesla, that means she is part owner of that company. And as part owner, there are some benefits that you get, which include if the company makes money, you get a portion of that money. And this is what we call dividends. And this is one way you can make money with stocks. Another way is by buying the shares. You buy the shares at a low price and sell at a higher price. For example, we were giving an example of KCB. Right now it is trading between 50, 56, 54 shillings. So you can buy KCB at 54 shillings, and once it reaches 60 shillings per share, that difference is your profit. So once you've understood that and you have assessed the risks that come with investing, because at the end of the day, regardless of which asset class you choose, there are risks. So understand the risks and get to understand, are you comfortable with that risk? If you are, then you're good to start investing.
Let me stop you right there, actually, because I like that you mentioned that, because today's episode, we are discussing money and investment mistakes, okay? Mistakes that people make. So Stormzy made the mistake of not understanding the market, not understanding the game, and not being educated. And you're saying a lot of people don't understand what risk means. What does that mean?
Risk.
Yeah, when you say understand the risk, what does that mean for me? Exactly, yeah.
I'll use an example. For example, if you choose to invest in a company, maybe at the moment it is trading at 50 shillings per share. You have to understand that, yes, this company share price can go up or can go down. This happened with Safaricom a few years ago. It was trading at 40 shillings. People were expecting that Safaricom will continue going up. But what happened? A few months later, it went down to lows of 13 shillings, 17 shillings. That is the risk that you have to understand. Are you comfortable with seeing your capital going down by 80%, by 50%? If you're not, then sorry, but the stock market is not for you. So understand, you can gain or you can make losses. Once you're comfortable with that, you can get started.
Can I chime in right there as well to kind of like also put it into context in real life? Yeah. So in terms of like risk and approaching risk, say you need to go from you want to go from Mountain Mall and cross over down the highway on Thika Road to Garden City. This is like a 4-5 lane highway. What are your chances of surviving the first crossover and then the second one? when you understand that, I can lose my life, or probably like 70% chance of me losing my life, that's the risk. And then you're like, okay, am I willing to take it? And when you approach now what Gertrude just talked about right now, with that mindset, it gives you a little bit of peace, because you're like, okay, if this company that I buy today, its share price tumbles 70%, will I sleep at night? Am I okay?
70%.
Yeah. Am I okay? Will I continue on with my life? Will I eat? Will I sleep? Will I take care of my children, take my dog for a walk, all that kind of stuff without this thing bothering me? If you're able to say yes to those things, then yeah, you can handle that risk, and you should be in that investment.
So generally, if I want to call myself a good investor, I need to be able to stomach volatility.
Yeah.
What if I don't want to? So do I? Because that's another hot take. If I'm not investing in the stock market, then I can't call myself an investor. Traditionally, even like with landowners, people are told, if you don't have land in Nanyuki, I'm talking about Kenyan context, if you don't have land in Nanyuki, you can't call yourself a landowner. Doesn't matter if you have 100 acres in Lamu, it doesn't matter. If you speak to people who really, really love buying land, all of them have land in Nanyuki, and this is just something that's in the market. So if this is another investment mistake I'm making, if I'm not in the local or global stock market, but even particularly the global stock market, I can't call myself an investor. Do you think that's true?
Yeah, I definitely do believe that.
Really?
Yeah. Yeah, because why are you leaving money on the table?
Oh no.
This is like money you're just saying, you know what, I'm cool. I don't need this. I'm successful enough. I'm probably on the Forbes 100 list. So why should I give a shit about this?
Why should I give a shit about
Yeah.
this if I am on the Forbes 100 list
Exactly.
without the stock market? I have a business, a thriving business. I'm raising funds, particularly grants, which in essence is also very free money. So actually, why is it so strict that don't call yourself an investor if you're not in the stock market? Why? Gertrude, even like
I have a different opinion.
Yeah.
I believe that as long as you are investing, it doesn't matter whether you are investing in the global scene or the local stock market. As long as you're investing, you are on the right path. The thing is, just get started. So it's not an issue of land or stocks, global or Kenyan stocks. It is land and stocks. The US stock market and the Kenyan stock market. It's not either one or the other. It is both. That is how you are in that is the only way that you can achieve financial freedom. Because when the stock market, for example, what happened last year, not last year, 2 years ago, the Kenyan stock market was one of the worst performing. But this year, it is one of the best performing. So if your portfolio does not have both, when this side goes down, this other side will hold you up. So if you are concentrated on one side, what happens when the bad times come?
But I feel like what I'm saying is, what if I don't have any stock options at all? Can I call myself? Or maybe also what we're trying to say is, it's not a matter of if you're not in the stock market, you're not an investor. It's a matter of I'm a low risk investor. I'm a medium risk investor. I'm a high risk investor. But I'm just wondering, for that person who's watching this and they don't own a single share option anywhere, but they do have that piece of land. They have rentals. They have a business that's working. They're content. Can that person still call themselves an investor?
Yes.
Yeah, Stormzy doesn't think
a low risk investor.
Stormzy's like, no, you just have rentals, but you can't say you're an investor.
I mean, for the pure fact of, the whole term of investing, for sure they are an investor. But I think this is also kind of like what Gertrude just mentioned as well. It just comes down to what you're comfortable with.
Yeah.
At the end of the day, are you okay seeing the value of your property lose 30%? Probably not. Then real estate makes sense for you, because the stock market is volatile. You will have some companies that will have some massive swings up and down, and if it's not your cup of tea, then for sure, then you don't need to do it. But kind of like what I was trying to say is, there is, because of the risks and volatility and all that, which I have to say again, volatility is great. It's great for wealth creation because there's always a transfer. So just because of the pure fact that you are not in it means that there is something that you're missing. It's like having a plate with just rice and beans or your veggies. Like I'm just kind of like quoting what she's saying. There's a lot of diversity as well. So get a little bit of exposure and have a little bit of extra protection if all your real estate investments, caught fire, or some people just decide to destroy it. You're not taking a full loss. You have something else that's going to take care of you and substitute you either passive income or portfolio income.
Mm-hmm. How do I train my mind and my soul and my spirit to embrace volatility? How did you guys do it? How can you sit here and comfortably be like, oh, we lost 70% yesterday. Oh, there was a crash. We're in the red. Okay, whatever. Let's move on with life. How do you train yourself to do that?
Okay. So first, you have to understand how much risk you are comfortable with.
How? Yeah.
So let's say you have 100,000 and you want to invest. Instead of, if you can't, if seeing that 100,000 going down to 50,000 makes you have sleepless nights, then don't put that 100,000. What you'd rather do is allocate that 100,000. You can put 50,000 in a stable asset, for example, bonds, or bonds. Let's just say bonds for now. Then the 50,000, you can put it in high risk assets such as stocks. Or if you're not comfortable with that, you can allocate this 50,000, 25,000 to go to ETFs, which are managed by fund managers. That is, someone out there is deciding which. Okay, let me just finish this and then I'll explain what ETFs are. So 25,000 will go to ETFs and 25,000 to stocks. So from this 100,000, regardless of how the market performs, you know that the largest percentage that can go down is 25%. Why? Because you have allocated this money into stable assets. Okay? So, one, understand your risk appetite. If you can't stomach high risk, then put this amount into different portions according to different asset classes.
You know the way there is a personality test?
Yeah.
Is there a risk appetite test for my investments? Yeah. Where do I take that?
Do you have one?
Yeah, you have one. Where? Tell me.
Basquiat Capital.
Yeah.
Super simple.
Yeah.
Takes like 120 seconds to do.
Yeah.
We get the back end data, but you'll get like just a general blanket view. Oh, I'm a moderate risk taker. I'm a high risk taker. I'm a low risk taker.
What kind of questions do you ask in this test? I'm so curious.
Do you want us to look at it right now?
Let's look at it. I want to know. In fact, let's take the test now to see.
Okay, yeah. Let's do
it's only 120 seconds. I want to take that test. And everyone here, I would take that test. And if you're watching, take this test with us. Then we see. Leave me a comment in the comment section to let me know what kind of investor you are, what kind of risk appetite you are. And before we do that, I want to give thanks in the middle of this episode to Kofisi for giving us this beautiful, beautiful, beautiful set. I want to also thank HISA for pouring money into this podcast. As I say, we love money here. We really, really do. And we value and appreciate your support. If you're looking to invest in the global market, local market, please look at HISA. And last but not least, HFM. If trading is your thing, and they have the special offer, $500 cash back with your first trading investment, please reach out to HFM. I'm going to leave all these descriptions, all these links, everything down below. Click them, and at the end of the day, start your journey. You can't be here watching and you don't want to start. I'm hoping that in watching this, you want to start. Are you ready for my test?
Yeah, it's literally just loading.
Oh, okay. Oh, sorry. Actually, okay.
Yeah,
let's see.
You fill it up.
Where does my data go? Do you have data protection? And how did you guys come up with this test? Is it like a scientific method? Was it based on your personal experience? It is.
Yeah, it is. And we also had, of course, a little bit of science in it.
What is your age range? I've never felt so old in my life. Why are you looking to invest in the first place? Maybe that. How much experience do you have with investing? Maybe that. If you ever gave your friend $100 to save and then they happen to lose $20 this month, if you give your friend $100 to save and they happen to lose $20 this month, you would never trust them again. Ask what happened. Tell them to double down on whatever lost. Okay. Imagine you're planting a money tree. How soon do you want fruit? I like this test. It's friendly. When the market freaks out you, meh. How much loss can you stomach? Okay. Oh, and I like how you've done it. So, how much loss can you stomach? My latte price going up 5%, a bad Airbnb stay 10%, a used car repair bill. I like this test, actually. I like this test. A used car repair bill.
Okay.
When you drive a luxury car,
Yes.
sometimes you're like, wow, okay, and you move on with life. But that's why insurance is also something good. Which best describes your investment style? Oh my God, I'm YOLO. Whee! It's not very good. The S&P 500 average is 10% a year. You want to crush it? God damn it. Do you know about dividends, good stocks, bonds? Yes. Yeah. Have you ever created or followed a financial plan? Be real, we'll ignore on. Okay. How do you handle cash? Spend fast, save what's left. Save a little automatically. Every dollar as a job. How do you handle cash? Save a little automatically. Maybe let me put that. How often do you review your financial goals? A, New Year's resolutions count once a year. How much of your money income are you comfortable investing? This is longer than our 20 seconds. Oh, it says, dum, 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 dum. I'm a moderate risk taker, comfortable with some risk to make significant returns on my money. Interesting. I always thought I was high risk.
Oh, well.
I always thought, but now I know. And I think I do agree, because at the end of the day, like, I have children, so I can't go all in, because I'm like, I have to, last money back check it, okay, but okay. So you said there's a scientific way. Why does a test look like that? Yeah.
Yeah, first and foremost, it just has to be human. Like, someone should be able to understand it and not feel like they're being hit with a ton of financial jargon, and it's like you're at the therapist type thing. It's just like a casual conversation. Like, what do you think about these things? How do you feel? Give me your truths here. And then from there, there's a scoring in the back end, which will now give me numbers, and all these fall into like ranges. So I know, like, okay, so for this person who's a moderate risk taker, probably they are at 22. So I know, okay, cool. And as much as they are okay with risk, we also have to balance this out with kind of like what Gertrude was saying. Let's throw in a couple of dividend companies or ETFs in there to just help balance it out, so that they can be able to sleep at night, and just it's a slow process. It's just going to be nice and slow. So I also have like one of my first cohorts of folks that I work with who was like the only high risk person, and we went all in. So we went your whole YOLO way. And I'm happy to show you what we've done so far.
In terms of like, so can you tell me the most amount of money you've lost in the stock market, and what did you put your money into, and what happened, and were you able to recover? And could you also tell me the most amount of money you've made? And maybe not you, or maybe you could give an example of maybe one of your clients or something like that.
Yeah.
So they can, I like numbers being put in perspective, because at the end of the day, we might be sitting and saying, the S&P 500 has steadily given you 15% annually, but what does that really mean? So tell me, I put in $1,000 and then this is what I made, for example.
Let's just look at my current portfolio right now. Let's see what's hemorrhaging me the most.
Are you able to tell us the stocks in your current portfolio?
Yeah, happy to do it.
Please tell me.
Happy to do it. We have BYD is very recent. We have Comfort Systems, that's FIX.
What are you saying?
Sorry, these are American companies. So
Please simplify this. We have students in class, man.
I'm sorry. So to identify a stock on the stock market, Gertrude knows this to the T. There are specific short codes, if we could use that, that help identify that stock. So, for example, let's use an example of Pinterest. For example, people like Pinterest, to look for hairstyles if you're a lady, and style outfits if you're a guy. So Pinterest is listed on the NYSE, and their ticker symbol or their short code is PINS, pins. So when you're looking for Pinterest, you can, of course, use the name, but you can also use their ticker symbol, so pins. So to answer your question and kind of like what the current portfolio looks like, the last question first, how much is the most like one of my myself or my clients have made? But We actually trimmed this last week. We did this one right here, UAMY, United States Antimony. It's a company. We did 400% in a period of 3 months.
Wow.
Yeah, so we had to trim that and just let it continue running. So
What does trimming mean?
We just took profits. We just
Okay.
realized some profits and just let the rest continue to work.
314%.
From 500%. So we took 200%.
Okay.
Yeah. So that's one of the winners that we've had this year. Losers, there's definitely one that comes to mind right now, Power Solutions International. That's not doing very well.
Also, when you aggregate the total of all the stock options you have, so it aggregates to 18.
Yes, yeah.
Close to 19%
return.
Gain.
Yes.
Oh. So if you see something has made up to 300%, why not double down on that? Why take some out? What is that?
Well, this is now going to go into a different kind of like stratosphere when you talk about, of course, you can always add on to your winners. It's basically the best way to go ahead and do it by all schools. But for us, it's usually markets price in gains early. So when a company is like doing crazy reports for earnings, they're doing really well, the market will start pricing in the future gains now. So in as much as fine, it's going to continue going up and up, it'll get to a point where it'll just peak.
Okay.
And people will be like Gertrude said, like, okay, you know what? I've had enough. I've made a lot of money. I'm out.
Okay.
And then what does that do? It just tanks the price.
And for a beginner, how did you end up identifying that particular stock would do well? What were some of the signals that you got in the beginning that told you, let me just put some money in here now?
Yeah. So, oh my goodness. Now this is now like a full lesson on strategy.
Oh dear.
Yeah. So,
give me one thing. Yeah.
8 consecutive quarters of growth in terms of earnings. That's the first thing. You want me to keep going?
Yeah. Where did you get this information of 8 consecutive? From HISA? Oh, yeah. Where do I get this as a beginner investor? Someone who's curious.
So for the US stock market, there are so many free resources. You can either go to Google Finance, just type in the name of the company and stock price or earnings. Another one is Yahoo Finance.
Okay.
Do I remember the others?
Yeah, there's so many more. Remotely Full has that.
Okay.
There are other there is
investing.com.
Investing.com. You have Bloomberg as well. They'll have that information. Okay. CNBC.
Yeah.
We can go on and on and on.
This is why I have an issue with people saying, passive income. You have to work, my God.
Yeah.
Another investment mistake that people make. Is there something you want to? What mistake have you seen that people make?
So in my line of work, most new investors invest their money in the stock market, yet they do not have an emergency fund. So when something happens at home and you need to get your money, what happens? The stock market has already gone down. So this person is devastated. So before you invest your money in any asset, first understand the risks. Back to our discussion earlier. Then you have to allocate a certain amount of money for cushioning. In case anything happens and you can't access your money, what will you do? Don't put all your money in one side because things happen. So,
okay, good. Let me query that a little bit. So this is what you say, diversification, right?
Yeah.
Is that fear mongering or is that a true strategy? Because at the end of the day, what if things go well? Why is it that we're always so fearful when it comes to money that what if I lose it? I need to have another pocket somewhere. And also in building an emergency fund, because I've built one, it is painful. It is painful in 2 ways. You have to choose your pain. You have to work so hard to make sure you stay disciplined in putting that money aside in a particular place. Work so hard to be sure you don't need to take it out. But you also have to work hard enough to build your emergency fund and at the same time invest. I don't think it's possible, or you tell me, I don't know, to just sit disciplined, build an emergency fund first while watching the world pass me by, while watching these people make 314%. Why can't I diversify in that particular way? So That's another hot take right here. Diversification is fear-mongering. It's not strategy.
Well,
Shoot.
it is not.
It's not strategy.
It's not fear-mongering. That's the thing. As a smart investor, you're supposed to cover any areas that you might fall short. So, yes, there's the likelihood that the stock market will go up. That specific stock you want to invest in will go up tenfold. But as a smart person, you do not just put in your money somewhere just because of the likelihood that it will go up. You have to be smart. Therefore, yes, building an emergency fund is painful, but in this financial journey, you have to build that habit. It is a muscle that you're exercising. Therefore, you can't just choose shortcuts just because you want to take advantage of the gains. You have to be smart about it.
Stormzy?
I really don't even want to add anything to that because she said it perfectly.
Yeah.
Like when it comes to money, I mean, like it's just like going to the gym. You just have to like sweat and cry and be in pain for you to achieve what you want. Which is when you go to the gym, you want to look good. When you're doing your emergency savings, you're doing investing, you want to have a fat pocket, you know? So basically, it's now that principle. I'm like, okay, I will endure the pain right now so that I get to enjoy it later.
Okay. There's something I've seen that there's a hot take I've seen that I want to bring up here. Someone on the internet said, diversity is not all it's cracked up to be. Being mostly in S&P 500 for my accumulation phase allowed me to retire early. I had some international and some bonds, but there were drags on my overall performance. Not that I am not accumulating. I do have more bonds to buffer against volatility. Not needed, in my opinion, when I was in my 30s or 40s. Diversification is just find one thing, stick to it. The guy was able to retire early just through the S&P 500. What do you guys say? What do you guys think? This is exactly what we're saying.
Well, it could work, but let me take you back to the 2008 house? Yeah,
global financial crisis.
Yeah, when everything went down.
Yeah.
Most people lost their retirement accounts. So what did these people do during that time? You have been saving for years, 40 years, 50 years, 60 years. Just when you're about to retire, when you're about to leave the workforce, everything goes down. What would you do in such a situation? So yes, it does work for some people when they choose not to diversify, but as smart investors, it is wise for you to diversify just in case. But then no one knows what will happen in the future. So what we do is we take the lessons, we learn from other people's experiences, and we buffer ourselves. Because at the end of the day, you can choose strategy A and it works out for you. Another person, 20 years later, will choose the same strategy, but will have a different outcome.
Okay.
So diversification is a way of managing your risk.
What would you say is a stellar diversified portfolio? This is great diversification, good for you. Across the board, yeah.
That's the thing. It's not a one-size-fits-all.
What would the majority see as a good diversified? Because at the end of the day, we like to say human beings are unique, but we're pretty similar in some forms of ways.
No, because at the end of the day, even if you earn the same amount of money each month, you have different expenses. You have different ways of living. Therefore, you can't just say, everyone follow this strategy. It won't work because at the end of the day, each person is unique. Your behavior as Ivy is not the same behavior as Stormzy. The way you can handle 100,000 is not the same way Stormzy will handle that. Therefore, when you are choosing a strategy, you have to account for what suits you as Ivy, not what suits Ivy and Stormzy because they are earning the same amount. No.
I'm fighting you.
I know, but that's true.
Stormzy, what is give me an example.
I have a slightly altered thought process to kind of like, and I'm not bashing her. She's absolutely on point. However, there's a general rule of thumb when you look at General investing principle. So number one, the younger you are, the more you can take on more risk because number one, you don't have any responsibilities. And in the event of a market crashing event, you have, hopefully, if all goes well, you have a lifetime for you to recover because she said this, the stock market always goes up. So you can recover within your lifetime. So with that being said, there's some certain principles that you can apply. In your early 20s, you can be 90 to 100% invested purely in stocks. As you grow older, you start divesting out of stocks by certain percentages. By the time probably you're 60, 70 and you're older, you probably own very few stocks. So now the majority or the bulk of your portfolio is now probably bonds, which are slightly safer, if you could use that. And there's a principle. So like if it's 90-10 when you're 22, 90 stocks, 10 bonds. As you grow older, it'll probably get to a point where it'll be like 80% bonds, 20% stocks. So you're not exiting completely out of something. You have a balanced portfolio, once again, to diversify. So that's a general rule of thumb, because when you're older, your lifespan you're close to expiration, for example, if I could use that term. So for that, you just need to be able to have something solid, something protecting you, and of course, feeding you and taking care of yourself in your old age, stuff like that. Now, when it comes to me, so like I'll use my own example. I don't have any bonds. I don't own any land. Everything is strictly in the stock market. So to answer your question on that, what that person said in terms of using the S&P 500 as a wealth creation vehicle, that's what I do. I strictly believe, I honestly do believe that it is a vehicle for someone to achieve what you always talk about, achieving that $1 million status as a black person. Like I was even telling Gertrude this, I hate the fact that, black folks are always in fucking last place. We're just always, we always are. Look at our leaders. They're going to other countries, putting on a beggar's face, wearing Louboutin kicks. Like, come on now.
Watches.
Yeah, someone's wearing a proper expensive watch, but you're going to beg. Like, fine, you're portraying you have the wealth, but you people don't even have it. No, if that was the case, then why you even here borrowing? So that's just why I'm like, yeah, we need to catch up. We need to have black folks who are on these lists being recognized. Yeah, this person is very wealthy. We know he's wealthy, this is et cetera, and it is possible. So for me, I'm like, let me use the systems that the white folks have used to also get there on the map as well, and help other people as well get there, and that will improve our, what's it called? HD what? Human Dependency Index? I forget. HDI, whatever. Just like a quality of life. So yeah.
I have another hot take. So thanks for that, Stormzy. Gertrude and Stormzy. Someone said, parents should save for their own retirement instead of paying for their kids' college tuition.
Can you
No.
do both? You should do both. I think.
Do you guys have kids? I think the thing with parenting, I've come to learn, and maybe I'm going to impart some wisdom to our guest today, is don't get into it. There's two things that I find myself thinking about nowadays. One, being a parent means that you're ready to start someone else's story, not continue yours. It's not, this is a continuation of my legacy. It's not, I want a mini me. It's not, I want a partner in crime. I know people who even say, I want a retirement baby. You're making it all about you. And parenting should not be that way. So if you decide to have children, it's that, okay, my story is set. I'm good. If I leave now, I'm fine. And I want to start someone else's story, which brings me to the second thing you need to think about. You shouldn't get into parenting if you're not ready to be a great parent. Yeah. There's nothing more painful than sitting and feeling like an average parent and knowing that you could have been a great parent. So I think I can say, I have to commend your mom. Getting you into finance that early, that's great parenting. Great parenting is when you see all these people winning Olympic gold medals, and those are parents who had to wake up at 4 a.m. and wake those kids up, even if they're crying, even if it's painful, and tell them, run, tennis, play, swim. And you can only do that if you know that it's about starting someone else's story. So I feel like that's what I would say about parenting. So I disagree with this in that parents should save for their own retirement instead of paying for their kids' college, that means that's a parent who got into it for the wrong reason. You know, I feel like in 2025, we cannot keep glorifying oops babies, calling babies blessings, saying they'll come with their own plate. I'm just like, some things are just ridiculous. Those are my two principles of parenting that keep me grounded. All right. Away from the philosophy for a little bit. Every market crash, another hot take. Every market crash isn't bad luck. It's rich people reshuffling ownership while we panic. And this goes back to what it is that you said in the beginning. And the first time I found out about this, I was crestfallen. I was like, as you said, the game is rigged. I'm like, so do I even have a chance? There's a lot of inequality. What would you say to that? Because we've mentioned market crashes a lot. So in fact, start by explaining what is a market crash.
Yeah, market crashes are just basically human emotions just on steroids. When people panic, this is something Gertrude just talked about. People panic, they sell, and they don't give a damn. They will just sell for the sake of selling. Because, oh, such and such is happening. Oh, this is happening. Oh, there's a Cold War. Oh, oil crisis, all those kind of things. And we've seen this in the past. This is like from like the 13th, 12th century when there was a huge tulip. This is for folks who've like gone to Amsterdam. So there's like tulip season. And, you know, back then there was like a huge tulip market. So everyone was doing tulips. And this was like the first ever recorded crash because the market became oversaturated and people started panicking and they started selling off these things. So something that was like probably like in our own dollar terms, maybe $100 for a single tulip was now 50 cents, you know, huge difference. So major losses. So we've recorded these as humans over the course of time. So it's human nature. People do this. Markets have to go through this as well. And they always do this and they manifest in different ways with different events. 2008, what Gertrude just said, with the global financial crisis, people lost homes. Dot-com bubble and bust and boom and all that kind of stuff. 2000, the Gulf crisis is when you look at oil, the Great Depression. All those things are like pre-recorded historical facts and events that caused markets to turn. And yeah, people definitely lost money. But if you look at it using like you zoom out and look at it in the grand scheme of things, these were just great moments of discounting. So what you just said, people with money understood, okay, this is now what's going on. People are selling on the way down and losing money. What am I going to do? I'm going to do the opposite. They're getting rid of these things. They're giving me back shares at a discount. So I'll continue buying. Okay. Because I know, you know, the American empire will continue being the American empire and will continue innovating and becoming the superpower that it is and continuing that until such a point in time, probably like the Roman Empire, whatever happened then. If that event happens, then there's going to be a global shift in power. But for now, and since the 20s and before that, it's always been the United States. So market crashes basically are, like I just said, you know, just discounting opportunities which are extreme. People lose money, unfortunately, but smart people always take that as an opportunity because there's always that. For every crisis, there's an opportunity. So in a nutshell, I will say it's painful to be in the market when that's happening, but it's such a great time, especially when intrinsic value of some companies remains. If you look at COVID, Zoom, for example, that was
nuts.
Yeah, it was absolutely crazy because there was an opportunity with that crisis. Some consumer staples enjoyed a ton of gains because people were stocking up on toilet paper and things like that. It's just mundane stuff.
You have to be, actually, I like that you've said that, Stormzy. Oh, is my sign falling? Are you seeing that? I like that you've said that, Stormzy, because what is making me realize sitting here is that to be discerning as an investor, you have to read widely. You have to pick up every single book, whether it's the Tao of Warren Buffett, whether it's the history, whether it's farming in Mesopotamia. You just never know. Like, pick up those books, read, and keep that information, because sitting there is when you realize, oh, this happened 30 years ago. Tissue went up. This happened, whatever. The digital age is rising. this is the time for Africa to rise, following what happened in Asia 50 years ago. And then you purchase with that in mind. But you have to stay prepared. All the questions I keep asking, where do you get this info? You have to keep getting the information. It's actually something that we say with one of my friends. Due diligence is a lifestyle. It doesn't just happen once. It doesn't stop once. So thanks for saying that. Gertrude, you had something to add around market crashes. And while you add that, please talk to me about who gives these discounts? Who manipulates the market? Is it manipulated? What happens? Yeah.
Okay, so to add on what Stormzy has just said, you have to understand when a market crashes, what is happening. Right? So, for example, a few weeks ago, when Trump announced the 100% tariffs on China, what happened? People panicked. And when people panic, they start selling. When they start selling the shares, the share price goes down. So when you see that market is red, that means most people are selling. But the question is, does the intrinsic value of that company change? So that is where the discount comes in.
Okay.
Yes, the share price has gone down, but has the value of that overall company changed? Does it mean that when the share price is going down, that company is not making money? No, it does not.
Okay.
So as a smart investor, when others are fearful, that's the time you come in.
Okay. When you say that, that means that's the time to buy.
Be greedy.
Yeah. Warren's a question.
Yeah.
I'm actually very happy that she said it because everyone says that, So is this the time to buy? Is this the time to hold? Is this the time to... So when it's crashed, be greedy.
Yeah. Warren Buffett said it best. When others are fearful, become greedy.
Okay.
And when others are greedy, become fearful.
Okay.
So at the end of the day, once you have picked your strategy, you have done your due diligence in this company, when you see that the share price is coming down, understand why is that share price coming down?
Yeah.
Is it the best time for you to buy? Once you get that, you're good to go.
Okay.
Yeah.
As always, here, it's not just any other podcast. It's just money. I like to involve the audience because you're not an audience, you're a community. I want to bring you into the conversation. So, of course, let's get into our calling segment. All right, you know what time it is. It's time for the Just Money Hotline. You call, we listen, and together we unpack your real life questions. Business, money, career, or culture. Let's see who's on the line. If you could please introduce yourself, who you are, what you do.
Okay, my name is Mwendwa. I'm a young Kenyan citizen, and I run a business with my friend where we sell second-hand clothes.
Okay, good.
Yes.
Nice to meet you. What's your question today?
So I have 3 questions.
Okay.
The first question I'll ask is, how can someone tell the difference between temporary setbacks and true financial mistakes? My second question will be, do you think people lose money because of bad investment or because of bad emotions? Then my third question will be, how can investors tell the difference between a temporary market dip and a true red flag? Yes.
Okay. Are you an investor?
I'm trying, because of late, I'm trying to look at the money market. I'm trying to understand how money market funds work. So I can't say I know very well, but is a field that I'm trying to enter and see if it can help me in one or another. Yes.
Okay. All right. Who'll take which question? How do you tell a temporary setback? What?
Temporary setback from what was it again? From a red flag, from a true financial red flag, something like that.
Yeah.
Yeah, I'm happy to answer that.
Yeah.
I can take that.
That's a good question.
Yeah, that's a great question. Temporary setback is something that you can be able to look back and laugh about. Personally, that's how I would look at it. I'd be like, I went for a night out. I spent 20,000. My budget was 10. Does that stop me from eating dinner tomorrow or the day after and stuff like that? No. Or if the answer is yes, then I know that's a bad decision. So for me, that would be like a temporary setback. Now for like a major red flag is going into something very serious and not doing the legwork, doing the due diligence, something that Ivy just talked about. Looking at the fundamental reason why I'm even doing it in the first place. Is it for my own gain? Is it to give back to community, etc., etc.? So when I have my truths, I can be able to fall back on them and say, okay, I want to go ahead and do this because there is a chance of some potential gain. I'm willing to take on the risk. If it fails, it's okay. I can still continue on with my life without having any major issues. But something that's a red flag for me is something that you just dive into without wanting to do any legwork. You don't want to do research. You met your friend at a bar. They told you this is the best thing that has ever happened since sliced bread. And you're willing to just put all your bets on the table and say, I'm going to go all in. And you end up paying the full price for tuition, which is something I always like to say. You have to learn a lesson, and for that you have to go to school. Schools cost fees, and you will pay the fees for that to learn that lesson. And that's just how the world is designed. So when you can be able to distinguish the two, I feel like you have your answer there. You're basically able to say, this was a temporary setback, I'll bounce back. Or this was a dumb decision that I made, I'm paying the price for it now so that I don't pay it in the future.
Good. What was the second question? Do people, Gertrude, I'm sure I can answer this, do people lose money in a bad investments or through bad emotions?
Well, one thing, when you are investing, you have to learn how to manage your emotions. So most people lose money through not handling their emotions. Because at the beginning, when you were making that investment choice, you chose, I see, for example, what our caller has said. He is looking into money market funds. So when you are investing, understand, yes, I've picked money market funds. What do I want this money market fund to do for me? And before you exit or want your capital back, has that been achieved? If not, then stay in. If things have changed, for example, right now, the rates in the money market fund world have gone down. Last year, money market funds were giving rates of 16%, 15%. Right now, they are giving rates of 13%, 12%, and even for the most famous one, Safaricom's MMF, it is as low as 7% and going down. So understand, why is this going down? Is this something that I can weather? Is this something that I need to look at? Because yes, the money market fund account rates have gone down because of how the bills and bonds in the bonds market are performing right now. Last year we had highs of 18%. Right now, the recent issued bond is 12%. So obviously the rates will go down. So understand, why am I investing in this? When things change, should I move? So manage your emotions.
So there's no such thing as a bad investment?
No, you just have to, when you are investing, when you choose it, what did you want the outcome to be? Have you achieved it? If not, then choose to stay or readjust your strategy.
Okay. Stormzy, you have anything to add?
No, she absolutely nailed it out the park. At the end of the day, emotions, like I said, basically run markets. And if you're able to just manage, and this is like even in The Intelligent Investor by Benjamin Graham, it's, oh my gosh, there's like, I think like 2-3 chapters just talking about emotional discipline. It's critical for anyone who wants to get into any kind of investment, whether it's stocks, bonds, real estate, anything. Heck, even if you're going into sports, that's an investing. You're investing time and energy.
Getting into a relationship.
Yeah, getting into a
relationship. It was like, come on, a broke man's foot is a poor investment choice.
Yeah, basically that kind of stuff. So
okay. Yeah. And do you guys have anything to say? Because he said I asked him if he's an investor, and then he said he's looking into money market funds. I know you guys have something to say about that. I know it. Let's just get it over and done with.
Man.
Is that?
You could go ahead.
So first things first, a money market fund account is not an investment option.
Even when it was giving you 18%.
No.
Gertrude,
The
even if
bonds.
last year it was giving me 18%, I couldn't call it an investment last year.
No.
Damn.
There's a difference okay, so a money market fund account is not an investment. It is a saving option. Why? Because the purpose of a money market fund account is to preserve your capital and give you a return that is above the rate of inflation.
It does give me that.
It does, but at the end of the day, is it giving you enough? So, the difference between an investment option and a saving option is that an investment option gives you high returns. Keyword returns.
Keyword high. High according to who?
Yeah.
High according to who?
According to other
Higher.
assets, you have to compare
Okay.
based on what other assets are giving you.
Okay.
But a saving option is you, from your income, you set a certain amount aside so that you can use it later. So why do we choose money market fund accounts? One, you choose a money market fund account to store your emergency fund. We talked about it earlier. You can't put your emergency fund in the stock market because the risks. But in an MMF, your capital will be preserved and you'll get something, a small amount that is above the rate of inflation and other costs. So understand, what does each asset give me? What is the purpose of each asset? Okay? Christmas is coming. Have you saved up? No? Then an MMF is a good option.
By now, if you've not saved up for Christmas by now, just save up for next year.
Yeah.
I'm like, you're late.
Yeah.
You're a year late because Christmas isn't a surprise. Those
Yes.
things actually really surprise me. I'm like, where is that Christmas rush? Why are people broke in January? You're 1 year too late. You're 1 year too late. Okay, Stormzy, anything to add before we close the call segment?
Yeah, no, for real, I feel like she just nailed it. Gertrude is just like knocking these answers off the park, to be quite honest. I really don't have many additions.
Yeah.
Only to just say that 100% it's an emergency savings place where you can park up your money for your emergency savings or a sinking fund. So basically, if I want to just ball out, I'm saving to buy a car, I'm saving to go out to Afro Nation next year in Portugal. So this is like some money you can be able to access really quickly. So it's consumption money, emergency, all that kind of stuff. It's good to park it there instead of leaving it in your bank, where they'll use it to give it to other customers at a higher rate and give you the peanuts. Shout out to the banks for that, by the way.
Okay, and I think for the final mistake that I've seen people making, that I see Stormzy really, really talking about, is not paying attention to fees. There's a lot of hidden fees, hidden costs when it comes to your investment. Nothing is truly free, but you can get something at a very, very affordable rate. So Stormzy, kick up a storm.
Yeah.
Tell us about this.
Absolutely. And I'm glad we have Gertrude here. Yeah, I just want to just light a fire under her butt for a minute, because they also have fees. I would like to understand more. Of course, Gertrude, you can always just do the same for the audience as well. So for me, fees has always been the biggest hindrance for looking at investment options for someone else managing it for you. Of course, because they're like taking on the job of managing the risk for you, because you're either lazy or you're busy with other things. So you just go ahead and pass that along. You're like, I have this amount of money, make it work for me, and make it work for me in a level where I'm able to beat inflation and make capital appreciation or capital gains and possibly dividends. So cool, that's your job. But how much does it cost? That's one of the things that people they'll always look at the returns first. Oh, it's 13, 15, 20. This is amazing. So you just dive in looking at the plus. But when you do the math long term, reading the fine print and looking at fees, you tend to see where certain investment options lead in the long term. If you're planning to use a certain instrument for your long-term, wealth building, generational wealth type thing, how long does it take? Mm-hmm. So there is a chapter as well in the little book of investing by John Bogle. John Bogle is the founder of Vanguard. So Vanguard, if I'm not mistaken, has around about roughly $12 trillion in assets under management. It's huge, massive company. They manage a lot of money. So he is saying, this is someone who has $12 trillion managing this for different companies and all these things. He says, when you are looking to invest, you want something for cheap. You want to avoid unnecessary high costs because they eat into your potential wealth in the future. So we did this on a video on my TikTok, and we also do this as well with clients who want to work with us on Basket Capital. We look at the long-term possibilities for what they want to achieve. Is it $1 million? Is it $10 million? This is what we need to achieve on a yearly compounding rate to achieve that specific goal. If you use what's out here in the market, how much are you going to be making and how much are they going to be making?
Yeah.
There's a fee.
Yeah.
5%, 6%, 2% if it's a money market fund. Cool. What are other options out there? Are there any cheaper options? Yes, they are. You can do it yourself and save 4.97%.
Or lose everything because I don't know.
Yeah, you could, but what are the odds? Probably not.
Yeah.
If you look at it long term. And this is back to what Gertrude was saying. It will always appreciate in value. So if I can be able to ride that, do it passively for low cost, I'm in a net winning position. And that's kind of like what I was talking to Gertrude as well. You know, HISA has fees. I don't know if it's on deposit. I don't know if it's AUM. But I know it's, if I'm not mistaken, you can correct me if I'm wrong, it's 1%. I don't know if it's 1% on deposit, 1% on AUM, and all those things. If it's just good if we can be able to shed that light, and then we can compare.
Or even before Gertrude sheds a light, before you light this fire, and Gertrude is very capable of handling fires. Talk to me about the 5%. I told you this is a very transparent whatever. So the reason I asked him about this is I recently saw a video that he made on his TikTok around Mansa X. You said Mansa X charges 5% on the net amount that you put in, right?
Yeah, I was actually corrected.
Walk me through. Yeah, just walk me through, because just put numbers in perspective. Yeah. I want to hear, if I want to make $1 million in, I want you to put those for me. And if you need to bring out your calculator, because I know you'll do this calculating thing, please bring it out. So by the time someone is done here, I want to know how much I have made versus how much I have made for the broker that, you know, is allegedly giving me this breakthrough product.
So I like using the NerdWallet mutual fund calculator. It's very simple. You just plug in the numbers and then you proceed.
Yeah.
So I was corrected actually on that video. I'm told the returns are net.
Okay.
So these are after. So they've taken 5% already.
Okay.
But if we just add the 5%, then we can be able to see how much we really are making. So I'll even give this calculator to you. You'll do the math.
So as he said, we are on nerdwallet.com and we're using a mutual fund calculator. So it says enter your initial investment, future contributions, time horizon, and projected annual return. So my initial investment, let us work with $1,000.
Yeah.
Time horizon, we work with?
We can start off maybe 10 years.
With 10 years. Yeah. Okay.
Mm-hmm.
Fund expense ratio is?
Now the AUM fees. So Mansa charge 5%. So when they report, they say they do annualized of, let's even give them 15%. So they're doing 23%. Yeah. So let's just say they're doing 23 gross and then giving you 15. Sorry, no, I'm doing bad math.
Do you need the calculator?
And I might need it. Let's just use something simple. Let's use...
It's 18%. Not the 5%, really?
You know, the 5% is...
So when you do the math, it's more than the 5%.
Oh, yeah.
So how much is it? So what am I putting in here?
So you'll put 18 plus... So they're saying they'll give you 18%. So do 18 plus 5. So it will be 23% return.
Okay. So that's what fund expense ratio is?
No, that's... Expense ratio is 5%.
Fund expense ratio?
5%.
Okay, because I was like, what are you saying?
Yeah, but the rate of return will be 23. So 18 plus 5.
Okay, so rate of return is 23.
Yeah.
Okay, good. Okay, I get what you mean. And then, of course, future planned contributions per year. So remember, we initially put in 1,000. If we put in 1,000 every month, a year, that's 12, right?
That's 12K, yeah.
Okay, so let's calculate. Ending value net with fees is $338,000. ending value gross is $452,000. Cost of fees is $114,000. I've given them $114,000.
They've made $114,000
You
using
have
your money.
off me
Yeah, off of your money. So if you just
in 10 years.
yeah, just do 20.
20 years.
Yeah, just do 20.
Let's do 20 years. 20 years. They've made $1.9 million.
And you've made
$2 million.
so they're almost closing in on you.
So, because gross is $4 million, so I'm looking at the net.
Yeah.
We always look at net. So
Yeah.
$2 million net, but cost of fees is $1.9 million. It's the same. It's 50-50.
50-50.
Yo,
There's a book called Where the Customer's Yachts. That's the question there.
so if you're watching this and you're a Mansex person and you think in decades, in 30 years, and please, by the way, I'm not against Mansex. I'm not against,
Yeah,
if you're there,
absolutely not.
congratulations, you're an investor. I'm just like, I'm very surprised. After 30 years, if you're ready for your retirement, you'll retire with $11 million, being consistent, putting aside $1,000 every month with your initial $1,000 investment. It seems little, you will push yourself.
Yeah.
So you'll make $11 million, but the cost of fees is $21 million.
There you go.
Shit. Whoa.
Yeah.
And why I love this so much is because we are told let me stop the recording. You're told think in decades. You are told think in decades. So if you're 20, you have a good job, you put that in 50 years, by the time you're 50, you've worked for that particular fund manager.
Yeah. Where are the customer's yachts? That's the
This
question.
episode is going to be a problem.
Yeah.
Oh my God. Oh my God. Okay. So yeah, an investment mistake. Look at the fees. Are you able to answer his question about why you guys charge 1%?
Yes. So let's start with HISA is a trading platform that you can use to access the US stock market and Kenyan stocks. So why do we charge 1%? And this is the lowest in the Kenyan stock, in Kenya, to be precise. So no, we don't charge management fees because we are not handling your money. We're just giving you access to these markets. At the end of the day, it is up to you to pick, do I want to buy Nvidia? Do I want to buy Tesla? Do I want to buy Safaricom? So what do we do? This 1% is not charged on the deposit. No, it is charged when you buy or sell stocks on the platform.
But
Just
there
that.
are others who charge
Yeah.
0.0000000.
Not in Kenya. Not in Kenya.
But elsewhere.
But I can get those platforms here.
It's quite
can download
tricky
them.
unless Stormzy can share what he uses.
Yeah, I use eToro left Kenya a long
Yeah,
time
you
ago.
told us to F off. Yeah.
Yeah, Interactive Brokers, it works, but the KYC it's really hurting people because it's very strict, it's very stringent, and it trips up a lot of people, especially when it comes to proof of residential address. It's tough because we're in a third world country. You don't have like proper street names. All those physical address things really don't make sense, and even finding a document that says I live here, it's a bit of a.
So which one works? Which one do you use?
I use Interactive and I use eToro before they
So
decided to exit.
you've given us nothing. So
I,
let's use HISA. You've given me nothing because eToro, I can't use it. You've told me Interactive is a bit
it's hectic,
hard.
but you can use it. Like all my clients are on Interactive.
Okay.
Yeah.
But
Okay.
I also hear that it is expensive to fund your account.
Yeah, bank wires.
Yet,
Yeah.
HISA,
Yeah.
how much do I need to start off?
For the US stock market, global ETFs and stocks, you only need $1 or 130 shillings.
I like that.
On HISA, you can buy US stocks with Kenyan shillings.
Yeah.
You can deposit direct from your M-Pesa
Yeah.
and buy any global stock.
Yeah.
So
Do you,
in Kenya, HISA is the best. And this is not coming from me because
As a
I
HISA
work there.
person.
Yeah.
yeah, right.
I also use it during my personal investment journey, and
Yeah.
it has been the best. In terms of fees, it's the lowest. For the others, to access the Kenyan stock market, they charge between 1.6 to 2%. The highest I've seen is 3%. So in terms of fees, HISA is the best.
Okay.
Yeah.
Good. We're coming to a close. I have thoroughly enjoyed this conversation. So I always also like to ask my guests, if not for anything else, if someone forgets everything you've said, one quick statement that people can take away at the end of this episode, what would you say, Gertrude?
I would say learn. Understand, what am I investing in? What are the risks? Just learn. Start by learning.
Okay.
Yeah, for me, it's a marathon, not a sprint. It does take time. You will pay. There will be instances where you'll have to pay tuition to learn a lesson, but you will come out wiser. And yeah, for me, it's always about just playing the long game, doing it like Buffett and Munger. Just long. Enjoy the process. Stop and smell coffee. Stop and smell the roses along the way. It's not. You only get one life, and you're given one body. So take care of yourself and enjoy the journey. It's gonna be fun.
Awesome.
Yeah.
Thank you, guys. Thank you, guys. If you want to follow them across all their social media platforms, I'm going to be able to leave those links here. That is Stormzy. Find him on TikTok, Instagram, anywhere else you're at. Are you on
YouTube as well?
YouTube as well.
Yeah. Mm-hmm.
And Gertrude, also the same thing. Find you on TikTok, Instagram, and also, of course, under HISA. You can find me, just Ivy Africa. It's just Ivy Africa across all platforms. And of course, please remember to subscribe. If you have enjoyed this episode, remember to hit the subscribe button. It really helps me. I see that a lot of you watch, but you're not subscribing. Why? Why aren't you doing it right now? Just stop it. Just hit the subscribe. I'm waiting. Go back. I've seen you. Just go back and good. So thank you. Hit the subscribe button. Leave me a comment. Tell me if there are guests that you'd love to see here. If you have questions for Stormzy and Gertrude, please ask them and I'll force them to come to the comment section and answer them. Thank you to HISA, HFM, and Kofisi for being our sponsors. And of course, thank you so much, Kenyan Wall Street, for bringing this idea to life. Till next time. It's not just any other podcast. It's
Just
money.